Chalo people, let's start. It's one moment, I understand. 6:30, correct. Not before that, sir. Okay, people, let's start now. Okay. So today we plan to go with the next topic. That is leverages. Okay. So let's start with it. Before that, once again, good morning, everyone. Right. Though the accounting ratio topic gets over, you don't leave the topic just like that. Correct. Uh, so, sir, you had told no that you will give us that ratios at glance so that we can anytime look at it and we can revise. Okay, that part is done from my side. That we will definitely, I'll share it with you today. Okay, written on one piece of paper where you can use it as a wallpaper. You can print it, keep it. Done, fine. But your task continues, guys. What we will do, as long as our lectures are on, in between, I'll announce you. Okay, fine. Tomorrow for 10 minutes we will revise the ratios. Today also we can do that. Yesterday only the topic got over, so I can presume that you remember the things, right? Okay, so let's start, guys. So see, we are going to talk about ratios and the system continues. Means what? I mean to say that initially I'm going to show you some important points, explain you few important concepts. Your task is to listen to me. Then at the end, what to do? Right, correct. Okay, yes. And then as a homework, you have to write that. Okay, we follow that system. Okay, so while learning right now, you can, without having botheration of copying the things, can go on seeing the things properly. And at the end, writing at home, those who have done it sincerely since last all chapters must have realized that in the evening when you write it back, things are like reconfirmed. Okay, like sort of concreting happens. Yeah, okay, fine, confirm, right? So that's a good practice to do, in fact. So let's start with that, guys. So I'm just coming up with some important concepts to you people. Okay, let me tell you that the topic is all about three formula. Okay, in the initial stage itself, let me tell you the topic is all about three formula: operating leverage, financial leverage, and combined leverage. There is no fourth concept to be learned in this topic. Okay, like ratios, like every day you're learning some more ratios, some more classification, one more type, these, that. Till yesterday also yesterday also we added a few ratios, saying okay, let's add a few more ratios, let's add a few more ratios. So eventually we ended up doing almost 2.5 dozen ratios. Yeah. So uh, here only three things to be learned: operating leverage, financial leverage, and what? Combined leverage. That's it. Only three things. Okay. So sir, first tell us what is this concept of leverage? See, leverage is a relationship between two numbers. Okay, let me come to it. Yeah. So what is a leverage? It is a relationship between what? Two variables, of which one is dependent on the other. So how leverage is generally calculated? Remember, any leverage would be like this, D upon I. Okay. What is that? Percentage change in dependent variable upon percentage change in independent variable. So not understood. Okay, fine. I have not explained also. Hold on, guys. Hold on. Okay. First, let's take a quick look at this income statement without talking about any kind of leverage and all. See, in the income statement, you have sales followed by what? Variable cost, then contribution, subtracted by what? Fixed cost. Then you get what? EBIT. This fixed cost are what? Operating fixed costs. Okay. Now you tell me. Now, as you can see over here, sales is 100, variable cost is 60. That is 60%. So contribution is 40. Okay. What happens in the second column? Sales becomes 200. Double. True. So variable cost is also doubled. Proportionate. From 60 it became 120. Okay. What about contribution? Contribution also doubled from 40 to 8. Okay. What happens to the fixed cost? Does the fixed cost change? No, fixed cost remains same. It was earlier also 10, afterwards also 10. Correct? So the resultant EBIT, now say sales, variable cost, contribution. All three have moved in the same proportion. What is showing a disproportionate movement? Fixed cost. Fixed cost doesn't change. Because of that, the EBIT also shows a disproportionate movement. Okay. So what should I say? Who changes whom? First sales changes because of that EBIT changes, or EBIT changes because of that sales changes? What you say, guys? Sales changes, so EBIT changes. Everybody agrees on this? So can I say EBIT is a dependent variable? Hello? Did you understand what I said? Right? EBIT is a dependent variable. It depends on whom? Can I say it depends upon sales? Increase, decrease, whatever. If sales changes, EBIT will also change. Right? If the sales increases, obviously EBIT will increase. If the sales decreases, EBIT will also decrease. So, but important thing is that you need to understand, out of sales and EBIT is a dependent variable. Okay. So now see, we are very much sure. We are very much sure that this number one, number two, number three, they move in the same proportion. Right? So there will be absolutely no need to calculate leverage for that. Means what? I know if sales doubles, variable cost also doubles, no? Yes or no, people? If sales doubles, variable cost also doubles, contribution also doubles. All three variables move in the same proportion. After that, fixed cost remains constant, because of which EBIT will not move in the same proportion. So EBIT, the movement would be disproportionate, right? And that is a place where I'll be keen on knowing that how much is the percentage change in EBIT because of percentage change in sales. See, I know that sales doubles means 100% change in sales, 100% change in variable cost, 100% change in contribution. No big deal, sir. They move in the same proportion. Change will come in EBIT. Will EBIT also change 100% only exactly? No. There will be proportionate change, or there will be a disproportionate change. Come on, tell me. There will be a disproportionate change. And there, that is where we are measuring the leverage. So out of sales and EBIT, first you recognize which is a dependent variable and which is an independent variable. Okay, I'm asking you the question. Sales is a dependent variable or EBIT is a dependent variable? Everybody understands this, that EBIT is a dependent variable, sir. Achha, it depends upon sales. So sales is an independent variable. Absolutely clear with this? Why we are calculating? Why are we not calculating leverage between sales and contribution? Do you understand that? Sales, let me repeat, sales, variable cost and contribution. All three will move in the same proportion. All three will move in the same proportion. So everybody knows, sir, if sales doubles now, sir, variable cost will also double, contribution will also double, no big deal, sir. But if sales doubles now, EBIT won't double. There'll be some, yeah, because of fixed cost, fixed operating cost. Did you get me? Right, people? Everybody out there listening to me? Good morning, everyone. Yeah, yeah. So let's start. Okay, so first point is clear. Dependent, independent variables are clear. Okay. Now, see, now before learning the operating leverage, though you know what you're going to talk about operating leverage, now let's talk about all these points. So it is what? It is a relationship between two variables, of which one is dependent on the other. So how would you calculate the leverage? It will be percentage change in dependent variable upon percentage change in independent variable. You know what is a better way? Like how to remember? We will say, hey, hello, this is not to be written in exam. This is for our understanding. Okay. So as we write now, sometimes our understanding. So what is our understanding over here? Change in dependent variable due to change in what? Independent variable. So I'm always having a question like this in the mind, that what will happen to the EBIT if sales doubles? See, I will never have such question in my mind about contribution, because if sales doubles now, variable cost also doubles, contribution also doubles. So there I don't have a question. Okay, so let's see. So leverages are a measure of risk. Why measure of risk, guys? You understand? That's a fixed cost. No, they don't change. Even if the sales increase or even if the sales decrease, fixed costs don't change, sir. And that is the reason there is always some element of risk. Okay. So important point. Number one, leverages are what? They are a measure of risk. Second one, leverages come into existence because of what? Fixed cost. So now comes the time to talk about fixed cost. See, first is operating fixed cost. Types of fixed cost or examples of fixed cost. First is operating fixed cost, like sir, fixed salary, rent. Okay, these are operating fixed costs. Financing fixed cost, guys. Financing fixed cost. I would love to know from you people. Okay, you have already read interest and preference dividend. Hello, people. Many of us have learned cash flow. Okay. We classify the activity in operating, investing, financing. Is that right? If anybody is there in the batch who has not learned cash flow, don't worry. It will gradually happen for you also. Yeah. But those who have learned, we can have a discussion. Operating, investing, financing. You learned from me? Okay. You remember the classification and the rule given? You have that thing right now with you? You have that notebook? Go through it. Go through it. Financing, investing activity. We have written related to what? Fixed assets and investment. One line rule. Correct? We have written what? Related to what? Fixed assets and investment. One line rule. Then we have written purchase of fixed asset investment, sale of fixed asset investment, and what is the third one? Interest, public, dividend, writing capitals, writing big letters, received. Hey guys, you remember or not? Did you write that word received in capitals? Ah. When we talk about, yeah, and put a box as well, correct? Okay. Then when we talk about financing activity, first we write related to shares, debentures, correct? And then we have written back issue of shares, debentures, bonds, comma, bank loan taken, right? Then redemption of shares, debentures, comma, bank loan repaid. And what is the third thing that we have written? Interest, oblique, dividend, paid. Paid becomes capital. Then I had told you guys, interest and dividend is not a deciding word. Whether you receive it or you pay it is a deciding word. So if you have paid interest or if you have paid dividend, then it becomes which activity? Third activity, financing activity. Remember? Okay. Flashback is over. Come to the present. So now getting back to the current topic. So when I say about fixed financing fixed cost, I am very clear to mention that it's going to be what? It's going to be interest. It's going to be interest and what? Preference dividend. Then, sir, did you mean to say that equity dividend is not a financing cost? Please pay attention to each and every word. Please pay attention to each and every word. 1 minute here. It is a financing cost, but it is not fixed. Correct? Preference dividend is a financing cost? Answer is yes. Interest payment is a financing cost? Answer is yes. Interest payment, preference dividend payment, both are financing cost and fixed financing cost. Equity dividend is not a fixed financing cost, it is just a financing cost. That's why you can see only two examples over here when we talk about fixed financing cost. Because then after this, people then will have a confusion. Ah, where gone equity dividends? Ah, equity dividend is a financing cost, my dear friends. Only thing it is not a fixed cost. Am I clear with this question? Okay, good. Yeah. So So now let's talk about operating leverage. Okay, so see, first we talk about operating leverage. Please notice it, guys, that it comes into existence because of what? It comes into existence because of fixed operating cost. Okay, so we take a very simple example. We have already written sales less variable cost contribution, and then what you see, sales, variable cost, and contribution all are moving proportionately. Then comes the fixed cost, operating fixed cost. What happens? It is same in both cases, 10 and 10. Because of that, you can see a disproportionate movement in EBIT. EBIT is not moving in the same proportion. Okay, so then how would you calculate operating leverage? Remember that that it is going to be D upon I. Dependent variable upon independent variable. Okay, now you tell me, see, out of sales and EBIT, we have already concluded that EBIT is a dependent variable. So percentage change in EBIT upon percentage change in contribution or sales. Sir, why are you writing both percentage change in contribution as well as or sales? My dear friends, percentage change in sales and contribution is same. If sales doubles, contribution also doubles now. So you can, for calculation sake, you can write anything. Okay, so how do I read this? If I, what do you mean to say, sir? We are not literate. Array, not like that, friends. How do we read this? We can read it like this. Percentage change in EBIT because of what? Percentage change in sales or contribution. Understood? So it's like we have that question in the mind. Okay. Right? So what is the interpretation exactly? Like we know that operating cost is fixed. So what we are keen to know that how much will be the percentage change in EBIT because of what? The given percentage change in sales. Am I clear? Okay. So now suppose we think of calculating this. So You know now how to calculate percentage change in anything. Still, I have written it elaborately. Change in EBIT upon what? Original EBIT into 100. So I'm just putting this so you can see the numbers as well. See, change in EBIT 30 to 70. Na? So the change is how much? 40. Divided by original EBIT how much? 30. Calculate this. Percentage change in contribution. Okay, so original contribution is 40. New contribution is 80. So the change is 40 divided by the original 40. If we calculate all this, it comes to 1.33. Okay, fine. Or there is a shortcut available. What you do? Operating leverage will be original contribution upon original EBIT. See what is the original contribution? Original contribution is 40, correct? And original EBIT is how much? 30. If you do 40 by 30, it will come directly. Okay. So what to remember? Operating leverage is what? Percentage change in EBIT because of, I never say upon, I say because of percentage change in contribution or sales. Yeah, I know variable cost also moves in the same proportion. Or for the sake of shortcut, what you can say, original contribution upon what? Original EBIT. Okay. What are the important points related? We have already orally discussed it, but let's summarize them. It shows tendency of EBIT to change disproportionately due to what? Change in sales. I hope everybody understands this, right? What it is a tendency of EBIT to change what? Disproportionately due to change in sales. Okay, fine. Now, operating leverage, in case the answer comes 1, that means no operating risk. See, theoretically, let's put it theoretically over here. I'm not going to change these numbers. Suppose this fixed cost are 0. Suppose this fixed cost are 0. Then what will happen, guys? EBIT will also move in the same proportion. You getting my point? Then what will happen? Then the operating leverage will come exactly 1. Because of percentage change in EBIT will also be 100%. Percentage change in sales will also be 100%. So operating leverage will come 1. So now you tell me, guys, when operating leverage will come? 1. When fixed cost is equal to 0. Okay. In reality, is it possible? No. Every business will have some or the other fixed cost. But to understand, right, that in case fixed cost becomes 0, then what will happen? Percentage change in sales 100%. Percentage change in variable cost 100%. Percentage change in contribution 100%. Fixed cost 0, 0, no change. So even EBIT will move in the same proportion. So what to say? If operating leverage is 1, then the risk is 0. As the operating leverage will increase from 1 to 1.1 to 1.2, 1.3, 1.5, what will happen? The risk factor will increase. Okay. Yeah, back to this. So what it shows tendency of EBIT to change disproportionately due to change in sales. Operating leverage of 1 will mean what? No operating risk. That is no operating fixed cost. Higher operating leverage will obviously mean what? Higher risk. Okay. So I hope everybody is clear till here, whatever we have discussed. It's a ratio, my dear. So it is times. I think people, you need to understand. Hello, everyone. Did I talk anything about profitability or so? No, I just talk about the risk. You remember earlier also I have discussed this with you people in capital gearing ratio. High ratio means high risk. Did I say that don't take the risk? No. Depends from person to person. Correct? As simple as that. The one who is risk averse would run away from it. The one who is like risk willing to take risk would jump into it. As simple as that. Right? If you remember, we have discussed this concept in working capital financing also. Question number 11. High risk, high returns, and vice versa is a universally accepted principle. Correct? Remember, guys, there we had written, okay, sir, aggressive policy runs the whole show with minimum working capital, takes high risk, but earns high returns also. Now, somebody would love for going for high returns. Somebody would say, no, no, I'm not. It's okay if I earn less returns, but I will take less risk. Depends from person to person. Okay, so now see, we talked about operating leverage. Should I should I say that you're okay with the operating leverage part? Okay, fine. So guys, in one word, you tell me operating leverage comes into existence because of whom? Operating fixed cost. Simple. Right, people? Okay. So let's talk about the next leverage, that is what? Financial leverage. Now, as we know that if operating leverage comes into existence because of operating fixed cost, financial leverage is going to come into existence because of what? Financing fixed cost, which is nothing but interest and preference dividend. Okay, fine. So we will have to consider the impact of interest also and preference dividend also. For that, see how we are doing. See, let's talk about financial leverage. First thing first, we need to understand that it comes into existence because of what? Fixed financing cost. Okay, that is interest expense and preference dividend. Yeah, see, I'm going to split the sums. Okay, I'm going to split the sums where the preference dividend is there and where the preference dividend is not there. Did you all clearly hear me? Are you in a state of mind to hear and analyze what I'm saying? Yeah, because just hearing is like we hear so many sounds, but we need to analyze it also further. Just that ears are there and they are open, so the sounds keep coming. Is the analysis happening? Yeah. Operating financial leverage comes into existence because of what? Fixed financing cost. Correct, friends? Which are the two examples? Number one, interest. Number two, preference dividend. Correct, friends? Right? So we're going to split it a little. We are going to study the effects gradually. Okay, because if I tell you right now, study everything, you'll run away. Okay, we will put the effects in two different parts. So that's why you can see on the screen. But initially, we are discussing only what? We're discussing only the interest impact. Am I loud and clear? Yeah, thank you. So let's talk about it. Yes, so make sure I get your messages. Thank you. Okay, so I'm just continuing with this income statement. Now, guys, just continuing this with income statement, sales, variable cost, contribution, fixed cost, EBIT. EBIT carried forward over here, 30 and 70. Okay, fine. Yeah. Okay, you can say I'm a little lazy to write all that. And that's why I've written only two, 3 pages. Interest expense. Again, you notice that the interest expense part is constant, correct? So EBT 25 and 65, assume tax at 40%. So 10 and 26. E80, earnings after tax. If you don't know that, then NPAT, net profit after tax is 15 and 39. You can check. Initially, what I told you, preference dividend, we are taking nil. So guys, you remember by any chance yesterday's discussion only. NPAT minus preference dividend. Mahesh, Ramesh, Suresh, no, Payesh. Aha, correct. Yes, right. So profits available for equity shareholders, right? Yes. So the profits available for equity shareholders are 15 and 39. Okay, let's say, assume number of equity shares to be 10, right, people? So what will happen? You will divide these profits by number of equity shares. What will happen? You get EPS 1.5 and 3.9. True, friends? Okay. Now see, understand. In this whole story, who is the villain? The villain is interest expenditure, right? See, rest all will move proportionately, right? See, everything will move proportionately. Only thing that is not moving proportionately is who? Is interest. You know what happens? If this interest factor is removed, now see, what is the ratio of the EBIT? 3 is to 7. 30, 70, no? So 3 is to 7. If I remove the interest, what will happen? EBT will also be 30, 70. Tax will also go in the same proportion. EAT will move in the same proportion. EPS will also move in the same proportion. But it is because of interest. It is because of interest. There is a disproportionate change from EBIT to EPS. Guys, did you understand what I said? Okay, let's do one thing. On the left hand side, there is a space, no? Write out in rough. Write out in rough. Okay, because people are not very sure. Sir, what are you saying, sir? Interest is a villain. No, not like that. See, let's give it a try. Okay. Suppose this is 30, 70. Understood now what we are doing? We're just comparing. Suppose interest is nil. Let's say this is nil. What will happen? 30, 70, right? Same now. Tax at the rate of 40%. So 40% would be how much? 12, and 40% would be 28 over here. I do 4s are na, 3 4s are 12, 7 4s are 28. So 60. So 18 would be left over here. And then 7 6 are 42 would be left over here. Okay. Check the proportion. 6 3s are 6 7s are. This is 3 7 only, guys. This also is 3 7. Preference dividend is as such nil. So this will also be 3 and 7 divided by 10. So it's a 1.8 and 4.2. No big deal, sir. That will, you realize that now every ratio you will calculate over here. Na? 3 is to 7, 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 3 is to 7. You understood what I'm trying to tell you? Whom did I remove? Interest I removed. And what happened? Everything is moving in the same proportion. Are you getting my point? Right? So it is that interest cost which is causing a disproportionate movement between EBIT and EPS. You just see the left side wala example. The example on the left hand side, if you see, you realize that if the interest part is removed, then suddenly everything started moving in the same proportion. So who is causing disproportionate movement, guys? Who is causing disproportionate movement? Is it interest? Yes. Between EBIT and EPS. Absolutely clear to all of you guys? Okay. So that's why, see what is the formula for financial leverage? Percentage change in EPS upon what? Percentage change in EBIT. So guys, like last time, how we will read this? How we will read this, sir? We are literate, sir. We can read this. Right? Not like that. For our understanding, how we will say? We will say percentage change in EPS due to what? Change in EBIT. Okay. Now understand, guys. Between EPS and EBIT, EPS would be dependent variable, correct? And EBIT would be, I hope you'll agree with this, right? First, who will change? EPS will change or EBIT will change? Eh, Akshita, first who will change? EPS will change or EBIT will change? EBIT will change. First, EBIT will change. If EBIT changes, then what will change? EPS will change. Absolutely clear to you guys? Right? Okay. Yes, yes. That's why EBIT becomes an independent variable. Okay. So the formula, financial leverage, percentage change in EPS upon percentage change in what? EBIT. Okay. So how you get it? Change in EPS upon original EPS. Okay. So for the sake of calculation, let me show you the whole thing. Okay. So Talk about percentage change in EPS. So change in EPS from 1.5 to 3.9. Difference is 2.4 divided by the original 1.5 into 100 upon percentage change in EBIT. So what is the change in EBIT? EBIT is originally 30, new is 70. Change is 40 upon 30. To solve all this, it becomes 1.2. Okay. So what we can say over here. Okay. Well, there is a shortcut method also available, huh, guys. Financial leverage is what? Original EBIT. Take the original EBIT upon original EBIT. Okay, and you will immediately get your answer 1.2. Okay, so whether you calculate this way or you calculate this way, answer comes same. It shows tendency of EPS to change disproportionately due to what? Change in EBIT. Right? Okay. Financial leverage of 1. When will oh, I think I've already shown it to you. Financial leverage of 1 will happen? Can happen, yes. It can happen in reality. See, operating leverage of 1 is difficult to find because every company will have some or the other operating fixed cost. Financial leverage of 1 is possible or not possible? Possible. Suppose the company doesn't take any loan, doesn't issue any debenture, so interest cost will become zero. No? Quite possible, no? Yeah. Means financial leverage 1 is possible. And if financial leverage 1 is possible, that means no financial risk. Just now we spoke that the company has not taken any loan, it has not issued any debenture, it has not taken any bank loan. Then the interest cost will be zero. If interest cost will be zero, then you've already seen how it will move, right? No? Here. See, you've already seen that how it will move. If interest cost is zero, you know how it will move. Correct? No? So in that case, can financial leverage be 1? Yes, financial leverage can be 1, where there will be no financial risk, no fixed financing cost. And then obviously higher financial leverage means what? Higher financial risk. So hope everybody is clear to this. Array people, my dear friends, excuse me. Hello. Yesterday also, people are still not coming. Excuse me. When I'm calculating leverages, financial leverages, what? This is what you're learning. Okay. In ratios also, the term financial leverage is used. Okay. So it's not a watertight. It's not a chemical formula of water that anywhere in the universe it is H2O. Please calm down. Excuse me. Are you able to hear me and understand what I said? People go restless. Financial leverage. Yesterday you told ATPT. Arey, my dear friends, when I'm doing accounting ratio and somebody tells me calculate leverages, one of the leverages debt equity ratio. Indicator of risk, guys. Leverage is basically an indicator of risk. Am I loud and clear, friends? Okay. So yes, you can always calculate financial leverage this way also. Financial leverage can be while taking ratios, you can say, okay, fine, it is debt equity ratio also. So nothing of it is wrong. Am I clear to this? Because some people always keep comparing the things. What to do? Nothing. Don't do anything. I will tell you what to do. First, you learn. Okay. Later on, you compare. If you're too busy comparing, then you'll miss on learning. So, hope you remember this formula that is presently important for me. Okay. Fine. Then the next one, combined leverage. You know, guys, it is a simple measure of overall risk. So according to us, what is the thing that has happened? It is a measure of overall risk. That is what? Operating plus financial. We have identified two risks because of fixed payments, operating risk and financial risk. So just a complete income statement in front of you, and you can see that there is a two places there is a change, right? You can see fixed operating cost over here. You can see fixed financing cost over here, right, friends? Now, because of this, what happens is some overall risk. So how to calculate this overall risk? See, it is as simple as that. Start from here and we'll compare this. Okay. So what we are going to say, percentage change in EPS because of what? Percentage change in sales. So if I say percentage change in EPS because of percentage change in sales, all these fixed costs are getting covered. All the risk because of that is getting covered. So combined leverage would be what? Percentage change in EPS because of percentage change in contribution or sales. Because we know percentage change in contribution and sales is going to be same. Okay. So how to calculate? Yes, let's calculate like this. Percentage change in EPS is what? Change in EPS upon original EPS. So again the same thing. No, change in EPS is 2.4. Original EPS is 1.5. Upon percentage change in contribution. Okay, fine. That what is change in that is original contribution and change in contribution. Both are same, right? 40/40. So this way it comes 1.6. There is one more option. You know what you can do? You can directly take original contribution upon original EBIT. Take a look at it, guys. Original contribution is how much? Original contribution is 40. Original EBIT is how much? 25. So even if you do 40 by 25, you directly get your answer. You can check on your calculators. 40 divided by 25 comes to 1.6. So it's a measure of what? It's a measure of overall risk. Okay. Yeah. Still, there is one more option. Okay. There is one more option. Check. Combined leverage, what we discussed, it's a measure of overall risk. Okay, fine. So take operating leverage into financial leverage. Okay, now if you take operating leverage, see, only when you are doing multiplication like this now, friends, take the total value. How much operating leverage is operating leverage we had got? 1.33. So actually it is 1.3333333333 full screen. Okay, then into financial leverage was how much? 1.2, no? Into 1.2. So see, it comes how much? 1.599999999999, and this is the answer. And it comes how much? It comes 1.6. Right, friends? Okay. Is this understood till here? Hello? Is this understood? Wait a minute. Don't take photographs. Wait and listen to me first. Did you understand? Okay. Quickly summarize the things. Quickly summarize the things. Summarize all the formulae. So first we learned today. The first we learned today was what? Operating leverage. Correct, friends. What is that? Percentage change in EBIT upon what? Percentage change in sales or contribution. And thing is, okay, right? You know that, right? Okay. Right. There is a shortcut formula also. What is a shortcut formula? Original contribution upon what? Original EBIT. Yes. Is that clear, guys? Let's talk about the second one. What is that? Financial leverage. Okay. How it goes? It says percentage change in EPS because of, see, that is, that makes it easy to understand. You read operating leverage, percentage change in the EBIT because of percentage change in sales. Now what next? Percentage change in EPS because of percentage change in what? EBIT. There's a shortcut? Yes. What is that? Original EBIT upon what? Original EBIT. Okay. Last one. Taking an overall picture. Combined leverage. So what it is going to? It is going to be percentage. See, now you have to visualize the income statement. That will be very clear. What is the last thing to happen is a percentage change in EPS. So we'll say percentage change in EPS because of percentage change in sales. So you are considering the whole wider range of the changes. Percentage change in EPS, that will come because of what? Percentage change in sales. Yeah, for the sake of writing, we can also write contribution because we know that the percentage change is same. Okay, shortcut formula. Original contribution upon original EBIT. Right, friends? Okay, wait. Remember, when what? Don't forget this. Okay, still we are running with this assumption. In the whole story, have we included preference dividend anywhere? You know why? Because the moment people will open the book and keep comparing, oh, sir, in the denominator there's something like preference dividend upon 1 minus t, sir. What is that, sir? Your formula is different, sir. Array, my dear friends, to keep it logical and make it simple for you, I'm putting it in two parts. First, I've explained the effect of interest. Then we will definitely consider what? Preference dividend impact also. Okay, these three formulae were quite logical to explain. With when the explanation went logical, right? So that's how we deal with it. Next step would be, yes, we will include preference dividend also. Now you all good to go. So suppose I have to have a further, like how, so how we should visualize like this. We have income statement starting from sales. Sales minus what? Variable cost. Gives us what? Contribution. Contribution minus fixed costs. That is operating fixed cost. Gives us what? EBIT. EBIT minus interest. That is a financing fixed cost. Gives us what? EBIT. Less tax. Gives us what? PAT. Earnings after tax, or NPAT, you can say, simplified. Less what? Preference dividend. Gives us what? Ish. Okay, and then you get EPS Ish upon number of equity ratios. Okay. So how to remember? See, if it comes to percentage formula, if it comes to what? Percentage formula, then see, it is like this. Percentage change operating. How operating leverage will go? Percentage change in EBIT because of percentage change in sales, right? Okay. How financial leverage will go? Percentage change in EPS because of what? Percentage change in EBIT. How combined leverage will go? Combined leverage will take a long route. Okay, so let's combine it. So combined leverage would be an overall look, right? So how it will start? Percentage change in EPS because of percentage change in sales. Hello, people. Did you understand what I did? This is operating leverage, right? This is financial leverage. And this fellow, this is what the combined leverage. Operating leverage is what? Percentage change in EBIT because of percentage change in sales. Financial leverage is what? That red color. Percentage change in EPS because of percentage change in what? EBIT. And combined leverage is the long range. Percentage change in EPS because of what? Percentage change in sales. Hello, people, what is happening in your life? You have understood this part which I showed. Is it clear? Okay, fine. Thank you, friends. So now, okay. So take a quick screenshots and then we will proceed further. So people done. I'll move to the next page. Then. Next page. Everyone listen to this, guys. Don't forget to write this when preference dividend is equal to nil. So I'm putting the whole discussion into two parts. Are you getting me, guys? I'm putting the whole discussion into two parts. Right now, I've just brought into the thing that if preference dividend is nil, this is how we will set the things. Okay. By including preference dividend, there isn't going to be a big change. There is going to be a change, but that gradually I would include. Am I clear to this discussion? Okay, fine. So let's go ahead. Combined leverage notes again. Let me do one thing. I'll put double page. Those who have missed it. What say people? Understood earlier, na? Now people are asking me continuously. That is the theory of the chapter over. So if you say yes or no, switch off our laptop, mobile, and go to sleep, sir, peacefully. See, obviously, people, this is the initial thing, right? I've already told you that I'm going to add the impact of interest. Okay, and then we have to go through a few questions as well, right? So time to go through questions, guys. Now, see, listen to me. Listen to me. Whatever space you need to write this, okay? After that, you will solve the sums, right? Then we will consider the impact of preference dividend, and then we'll solve the remaining sums. Am I clear? So initially, I'm going to take only those sums where their by default preference dividend is nil. Am I clear? Huh? Okay, fine. So let's start then. So we are good to go. We'll come to classwork section. Okay, let's start. The data, I know you will be able to solve it on your own also, okay, if you remember the formula. The data relating to two companies are given below. The data relating to two companies are given below. Equity capital, 12% debenture. Guys, we all know now how debentures will help us. Debenture will help us to calculate what? Interest component. Yes. Output. Okay. So units sold. Okay. Selling price is given per unit. Guys, you multiply this and you'll get total sales. Fixed cost is also given. Variable cost per unit is also given. Okay. Now what you have to do? Output into selling price per unit will give you sales. Output into variable cost per unit will give you total variable cost. You're required to calculate operating leverage, financial leverage, and combined leverage of the two companies. So initially, very easy sum, just involving what? Basic calculation. Okay, fine. So let's start. Okay, let's start, guys. So start from sales. I'm just right over here, na? Selling price per unit into units sold. Okay, so I hope that you can easily calculate. Hmm, 60,000 into 30, 18 lakh. Okay, and the next one is output is how much? 15,000. Okay, 15,000 into 250. Okay, let's what? Variable cost. So it will be variable cost per unit into what? Units sold. Okay. So the first case it is 60,000 units into the variable cost is given in the last line, that is 10. So 6 lakhs. Okay. Then 15,000 into 75. 11 lakh 25,000. So contribution, which is going to be 12 lakh. And this is going to be 26 lakh 25,000. Okay. Less what? Fixed costs. I think fixed costs are given ready-made in the question. 7 lakh in case of A limited and 14 lakh in case of B limited, right? Okay. So the difference would be what? EBIT, earning before interest and tax. That will come to 5 lakh over here. And this is 20 minus, right? Less what? Interest. Okay, fine. Interest, how will calculate? At the rate of 12% of debentures. Right, that's an easy way to calculate. So 12% of 4 lakh, 48,000, and 650 into 12%, 78,000. So the difference would be what? EBT, 5 lakh times 48,000 is 452. 1225 minus 78 is 11 lakh 47,000. Okay. Now, after this, do we have any other information to continue? Are we given tax rate? No, nothing is given. Are we given tax rate? But friends, you need to understand, right, that we don't even need it. What we need at the most to calculate the things, we need original contribution. What we need original contribution that we already have. We need original EBIT that we also have, and we need original EBT. Correct, right, people? You forgot that you have to prepare what you have to calculate leverages, and you don't have to prepare income statement. Right? People are always concerned, tax rate not given. See different messages that I have to ignore. Tax rate not given. Preference dividend not given. Number of equity shares not given. What do I do with them? I have these three values: contribution, EBIT, and EBT. That is enough to calculate, right, people? You just have to calculate three leverages. Okay. So below this only, we will use this space and calculate the leverages now. Okay. So calculation of leverages, the first one, operating leverage, which is what? Contribution of EBIT. So 12 lakh divided by EBIT of 5 lakh. 12 divided by 5, 2.4. My goodness, we are writing so much. Over here, we will calculate contribution as 3625 divided by 2.14. Yeah. So 2625 divided by 1225. So we got the answer 2.14. Okay. Let's go with the next one. What is that? Financial leverage. EBIT upon EBT. So that is 5 lakh upon EBT is how much? 452. 5 lakh divided by 452. 1.106, right, friends? So let's write 1.11. Over here, it will be 1225 1140. 1225 divided by 1147. 1.068. No, so let's write 1.07. Yes. And then the third one, combined leverage as what? Contribution upon EBT. 12 lakh upon 452. 2.65, 2.654, so 2.65. Here is going to be 2625 divided by what? 1147. 625 divided by 1147. 2.288, no? So let's make it 2.29. Okay, friends. Have you all got these answers, guys? Absolutely yes, na? Okay. I hope you all are done with this sum. Okay. That's it. Here we don't have to write anything. We're not. Are we asked to write like comments, like high risk, low risk? Anything asked? No. Calculate the ratio, then calculate the ratio and keep calm. Okay. Come to the next question. Question number 2. A firm's details are as under. Sales is given. Variable cost is supposed to be 50%. Guys, if variable cost is supposed to be 50%, we'll get contribution. Fixed cost is also given, right? And once you subtract fixed cost, what it will be? EBIT. It has borrowed rupees 10 lakh at 10% per annum, and it has equity share capital of rupees 10 lakh of rupees 100 each. Okay, calculate what? Operating leverage, financial leverage, combined leverage. Can you simply calculate this? I think it's easy to calculate. Okay, being the first sum, let us do it together. First means first few sums, no? Like you need a support. Okay, so let's solve last work question number 2. Solution to last work question 2. Okay, let's make a quick income statement. Started with sales. ₹24 lakh less variable cost at 50% will come to 12 lakh. Balance has to be contribution. 12 lakh. There's fixed costs. Fixed costs are given in question. How much, guys? 10 lakh, no? So we'll get EBIT 2 lakh less what? Interest. How would we calculate interest? We are very clearly told at 10% borrowed 10 lakhs at 10%. So 10% of 10 lakh. How much it will come to? 1 lakh. So EBT is going to be how much? 1 lakh. Right, friends? You still want to continue further? I'm not going to continue further. Not required. What is the question asking us to prepare income statement? Now, people. Hello, people. Has the question asked us to prepare income statement? No. What it has asked us to do? It has asked us to calculate operating leverage, financial leverage, and combined leverage. Knowing the values of contribution, EBIT and EBT is sufficient to do that, right? So why you are running after finding EPS? People have been desperately messaging in question number 1. Sir, what about EPS? Arey, what do we care? Why? Who asked you to calculate EPS? We don't need, right? Are we told prepare income statement? Then why? Why to take responsibility of preparing income statement of every company unnecessarily? Operating leverage is contribution upon EBIT. Contribution 12 lakh upon EBIT 2 lakh. Answer came 6. Right, friends? Yes. I can see your answers. Thank you. Then financial leverage, EBIT upon EBT. EBIT is 2 lakh upon EBT is 1 lakh. That is 2. Third one, combined leverage. What is that? Contribution upon EBT. Contribution is 12 lakh. EBT is 1 lakh. The answer is going to be 12. Right, people? Now see, some time back when we were discussing about theory, no, guys? This is a theory part, right? So, don't you see that I've written over here? It is written for whom? I have told already. What is combined leverage? You multiply both of them. Then what is the need to ask separately again and again? So should I multiply and find? Do multiply and find, no problem. Simple as that. Yeah. What happens if now see here in this question, what we have done? We are getting the exact numbers. Correct? Operating leverage is how much? 6. I'll show you a question. Operating leverage is how much? 6. Financial leverage is how much? 2. So you just do a multiplication, you get an exact value, 12. Right? Yes. Where the problem may come? Problem may come in these kind of questions, where sometimes you round off. So you may not get accurate values. So what is the best option? Calculate the contribution upon EBIT, EBIT upon EBT, take contribution upon EBT. That's it. Okay. Fine. So let's come to question number 3. Let's read question number 3. X Limited has estimated that for a new product, its break even. Its break even is how much? 20,000 units. Okay, people, you understand break even point. Everybody understands break even point. What is break even? No profit, no loss. That's what you always say, right? Correct. It's a very usual thing for you people. Anybody says break even, right? In the sleep also somebody says, hey, what is break even? No profit, no loss. Little more elaborate. No profit, no loss. That means all fixed and variable costs are covered up. Understand, friends? Hello. That is all fixed and variable costs are covered up. So now if we talk with a reference to our income statement, you know what will happen? At break even, our EBIT will become zero. This is very important because see, we buy at this statement very hard, very much fondly. Anybody says break even, we start shouting, hey, no profit, no loss, no profit, no loss. You do it in costing. Do you cover a financial cost in costing? No. And financial costs come after what? EBIT. You look at the income statement. Guys, take a look at it, any of your income statement. Where this the financial costs are chirping in. They are coming after EBIT. So when you say no profit, no loss, what do you mean? By saying no profit, no loss, you mean to say that EBIT is zero. Okay. It's a very important thing, right? People are like, sir, only 3 formulas in this topic. Okay, that means this is very easy. Wait, don't rush. Don't rush to conclude. Okay, there are twists and turns. Obviously, not like last question, last topic where we have 24, 25 ratios. We have only 3 ratios. But yes, it is going to bring some it is going to bring some twists and turns. So what we'll say? We'll say over here that at break-even point, what will happen? EBIT is zero. Understand? Yeah. So X Limited has estimated that for a new product, the break-even point is how much? 20,000 units. Okay, fine. The item is sold for 14 rupees per unit. So selling price and the variable cost is 9 per unit. Calculate what? Degree of operating leverages. Calculate degree of what? Operating leverage for sales volume 25,000 and 30,000 units. So if sales volume becomes 25,000 units and 30,000 units, then what will be the operating leverage is what has been asked to us. Okay. So in this question, the most important thing that we need to understand that at break-even point, the fixed cost and variable costs get covered, right? So from our income statement point of view, what would I say? Okay, fine, sir. If fixed cost and variable costs get covered, then I would say at break-even point, EBIT is equal to zero. So, anyway, let's come to the solution part of it. First, first and foremost thing right over here. At break-even point, therefore at BEP, what I would say at break-even point, EBIT will become nil. When you say no profit, no loss, it means what? In our terminology, EBIT would be nil. Then, uh, 20,000 25,000 and what? 30,000. Okay. So first we'll write what? We'll write sales. Sales at the rate of how much? 14 per unit. So this will be 20. Okay. Less what? Variable cost at how much? 9 rupees per unit. Correct, friends? So this should be 180, right? Just now, just us to 25 and just so we will get contribution over here. So this would be 1 lakh 125 150, right? Less what? Fixed costs. And once you subtract fixed cost, then what you get? You get EBIT, right, friends? Tell me, are we giving fixed cost in the question directly? No, we're not given. Fixed cost is not given. But do we have a way to find it out? Very much yes. In the first column, that's a break-even point level, right? Now, so what I can say, the EBIT would be how much? 0. EBIT would be 0. We put EBIT 0. Balancing figure would be what? Fixed cost. Correct? Yes. So if I put this nil, this would be. That's it. And then you know, fixed costs change or fixed costs do not change. Fixed cost do not change. Correct? Yep. So copy. Why this is nil? Since BEP. Okay. So here the EBIT will come to 25,000. Here it will come to 50,000. And I think that is enough of information for you to calculate operating leverage. Which is contribution upon what? EBIT. So here the contribution is 125 upon the EBIT is how much? 25. So answer is 5. And here it is 115 upon 50. So answer is 3. Yeah, if anybody needs a screenshot of the solutions. Yeah, if anybody needs screenshot of this question as well. Done, people? Are you guys done? Yeah. Okay. See. Uh, Tell me, have you learned break-even point in costing or not yet learned? Not yet learned. Okay. No problem. No problem. No problem. Listen to me. Listen to me. But we frequently use the word break-even point, saying what? At break-even point, there is no profit, no loss. That's a normal expression. Have you heard at least this much? Can you confirm? At least you have heard this much. What is detail of break-even point? You may not be knowing, but all of you have learned at break-even point what happens. No profit, no loss. Okay. See, yeah, in economics, probably you might have heard about this. But in economics, what happens? You draw the diagram. At the moment somebody starts drawing the curve, you're put off. Because people draw some kind of lines. You know what? How the variable cost curve goes. Variable cost from left to right, I'm sure. Okay, so it starts from here, then it like goes like this, then comes down at a certain point. Variable cost is lowest at certain point. Then it again starts moving up. So where comes the equilibrium? The equilibrium comes where the variable cost curve is intersected from below. Are you aware of this? No, then let it be. But see, means break-even point is basically what? We say no profit, no loss. Okay. In case you don't know right now, listen to me. What do you mean by no profit, no loss? Your fixed cost should get covered. That is called as a break-even point. Obviously, variable costs are always covered. You sell anything above that, you start making profit. Even if you sell 1 unit above that, you start making profit. As you can see in this example, what is the break-even point? 20,000 units is a break-even. Right now, you see this example only, you will understand it better. Okay. See, what happens with this fellow? Let's say that we never knew that this is the break-even point. Let's go the other way around. That he sold 20,000 units. His variable cost is at 2,80,000 rupees. His variable cost is 1,80,000. So he's left with 1,00,000 rupees of contribution. And he came to know that his fixed costs like rent, salaries, they are also 1,00,000 rupees only. So what is left in his hand? Nothing. Nil. He's not left with anything, but he is not at loss also. Correct? Now, friends, now after this, at 20,000 units, the fixed cost is covered. Now he sells anything more than that, automatically what will happen? Some profit will arrive to him. Am I clear with this discussion? Hello, people. Did you understand this discussion? Some people have been raising concerns about, so what is break-even points or what is this? What is this? Okay. So yes, you have learned it in economics, but still, like I'm repeating from my side. Some people are just like, no, 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 sir. What is break-even point? Some have not even heard also. So it's okay. So the simple idea is, see, you look at this example only and it will be clear that when he's selling exact 20,000, what is happening? His variable costs are also taken care of and his fixed costs are also taken care of, but earnings in his hand, EBIT is zero. That is what we say, no profit, no loss. Anything above. So what he has to fit in his mind, that by hook or crook, I should manage to sell how much? 20,000 units at least I can sell 40,000 also, I can sell 50,000 also, but at least to survive I should sell how much? 20,000 units is what I should sell, where at least I can survive. No profit, no loss. Okay, then he moves above 20,000 units, when he goes to that 25,000 units, what do you say? Variable cost taken care of, fixed cost also taken care of. Still, he is left with some earning before interest and taxes. Is that understood, people? Those people who have been raising concerns about break even. Okay. Yeah. So, you know what happened? The moment I said the word break even, people did not hear the second word, but they heard only the first one, break, break. And immediately they started asking for break. That is what has happened. People have already started putting messages, sir, break, sir, break, sir. Okay, 3-4 minutes break. It's due to you all, no problem. Yes, people, let's resume. Let's solve. Next question. Come to question number 4, guys. Come to question number 4. Let me have a quick discussion with you guys about question number 4. See, you're given a balance sheet. Okay, let's see what is given. A company had the following balance sheet as on 31st March 2020. Fixed assets are given, current assets are given, and equity share capital is given 50 lakh shares. Okay, this all is in what? This all is in rupees in crores, no? Right? So 50 lakh would be 0.5 crores, right? Okay. And reserve and surplus, 15% debentures. We all know that this will help us to calculate what? Interest amount and current liability. What is the additional information given? Fixed cost per annum. Pay attention, guys. Excluding interest. Okay, the words are very clear. This is fixed cost per annum. Excluding interest means only what is this? This is operating fixed cost. Right? Please mention over there. Variable operating cost ratio is how much? 65%. Means in simple words, it is 65% of sales, variable costs. Total asset turnover ratio. Oh my gosh. Total asset turnover ratio. Guys, you remember? Sir, it's not fair, sir. The ratio topic is already over, sir. Why are you taking? See, when it comes to exam, there is no such watertight compartments. Anything from anything can come now. Total asset turnover ratio, are we aware of? What is that, you tell me? Sales upon total assets, correct. What this will help us to calculate? Sales, correct. Yes, it will help us to calculate sales. Total assets is there now. Okay, what is total assets? So you should not ask so many questions of the topic which is over now. Not fair. It's nothing like that. Total assets is what? Fixed assets plus investments plus current assets. Huh? You remember now, every time this comes now, right? Application of funds is what? Total assets is what? Application of funds is fixed assets plus investment plus working capital. Total asset is what? Fixed assets plus investments plus current assets. So this will help us to calculate what? Sales, and the tax rate is given. See, now you're required to calculate what? You're required to calculate earning per share, and then as usual operating financial and combined leverage. So what we will have to do, guys, we will have to take our income statement right up till the end. Understand? Because we have been also asked to calculate what? They have not asked to prepare income statement. See, they have not asked us to prepare income statement, but for calculating operating, financial and combined leverage, I will have to make at least contribution EBIT, EBT. And then obviously for EPS, I need to go till the end of the income statement. So income statement we will have to prepare in full. Okay, so let's make solution to question number 4. I have to write sales minus what? Variable cost. Variable cost is how much percent? 65%. I'll subtract this. I'll get what? Contribution. Less what? Fixed cost. Fixed costs are given now 4 crore. Okay. So I'll get what? EBIT. Less what? Interest. How will I get this interest? It will be 15% of 10, no? Okay, I'll write 15% of debentures. Yeah. Debentures are 10, so 1.5. Then EBT. That's what? Tax. Tax at the rate of, given in the question, no? 30%. Get EAT. Or we can also say NP8. Less, less what? Preference. At present it is nil. So we reach till Paresh. Means whatever. After substituting we will reach no. Okay, so how to do this? Yes, we know it. We will use this total asset turnover ratio. Total assets turnover ratio is given to be how much? 2.5. Therefore, sales upon total assets is 2.5. Fine. Sales we don't know. Do we know the total of total assets? Yes. Okay, I'll mention for those people who don't know. Fixed assets plus investments plus current assets. Yes, we know the total of total assets right now, people. 20, correct. So from this, I got sales as 50. This is all in crores, guys. Okay. I think enough data to solve this. So this I will put as 50. So 50 into 65% came to 32.5. 17.5. 13.5. Which is 12. 3.6. 8.4. Yes. This is also 8.4. I think this is enough now to calculate everything. So the first thing that they have asked is to calculate EPS. EPS is PERS upon profits available for equity shares upon number of equity shares. Okay. So this is 8.4, guys. What I told you, 8.4 is crores, na? So 50 lakh shares will be how much crore? It will be 0.5 crore. I hope you're clear to this. It becomes 16.8. This one. Okay. Once you have this, EPS, once you have all these details, yeah, has to be what? This has to be rupees per share. Don't forget that. Huh? Then, as usual, calculate all other things. Operating leverage, contribution upon EBIT. How much was our contribution? 17.5 upon EBIT. 13.5. 17.5 divided by 13.5. 1.296 na guys. So let's make it 1.3. Yes. Then the next one, financial leverage, EBIT upon EBT. EBIT is 13.5, EBT is 12. 13.5 divided by 12. 1.125, so it's okay, na? 1.13 we can write. And then combined leverage, contribution upon EBT. 1.458, right now. So let's write 1.46. If it is 1.458, so let's write it what? 1.46. People make sure that you round off. Okay. Very easy. Hello, people. Finding it absolutely easy, right? Okay. There are some twists and turns. Let's come to the next question. Let's come to question number 5. Come to question number 5. Let's read question number 5. Okay, see what it says. The following details of RST Limited are given for the year 31st March 20. You're now given operating leverage and combined leverage. Such a nice people. Okay. Fixed cost excluding interest means only I can say operating fixed cost is given. Okay. See guys, what you do is now you remove all those commas, so you'll be very clear. Otherwise, what happened? What has happened in the past? Like people sometimes say 2.04. Let's say 204 lakh. Okay, so no confusion. So I'll remove. If I remove, then it becomes more strong. So 204. Okay. Don't consider these commas. Fine. Sales is given. 12% debentures are given. See, you all know why 12% debentures are given. They'll help you to calculate what? They'll help you to calculate interest. Okay. Equity share capital of rupees 10 each is are given. So you will know number of equity shares also. Tax rate is also given. What we have to do? Calculate financial leverage. Okay. Financial leverage would be very easy to calculate. You are given operating leverage, you are given combined leverage. So you can use the formula for combined leverage as what? Operating into financial and quickly get what? Financial leverage. Calculate PV ratio. Anybody knows what is this PV ratio? Profit volume ratio. Anyone knows profit volume ratio? No problem. Hello. By the name it goes, no. By the name it goes. You don't know, it's okay. Don't predict. Wait. Contribution upon sales. Contribution upon sales. So how much is contribution? Percentage of contribution with that of sales. Listen to me. Listen to me. You remember I had used this in one question. I directly wrote the sales minus variable cost as contribution minus fixed cost as EBIT. And some people started saying, sir, we don't know this, sir, we don't know this. That time I had shown you the comparison. See, there are two ways of writing it. I don't know how many of you remember. Sales minus COGS gives us what? Gross profit. Okay, and then subtract operating expenses gives us what? EBIT. Right? And then the second format is what we are talking about today. Sales minus variable cost contribution, contribution minus fixed cost EBIT. You remember I had shown writing both these things side by side. And I told you, see, some people are focused on getting GP, correct? And then followed by EBIT. And some people do what? Take those same cost of goods sold and other operating expense, and bifurcate it into two parts. Few as variable, few as fixed. You guys remember this? We had a discussion about this. Acha, we did this, and thank you, friends. Thank you for reminding. Talking about receivable management, we did it. Good. So, see, there, when we prepare an income statement like sales, COGS, GP, we calculate GP ratio over there. We compare GP with that of sales. Here, what we are doing? Profit volume ratio. So, we are comparing contribution with that of sales. And then calculate what? Earning per share. Okay, fine. If the company belongs to an industry whose asset turnover is 1.5, does it have a high or low asset turnover? Okay, fine. This is offbeat question. Okay, right. It reminds you of what? It reminds you of ratio topic, comparison, commenting. And then the next question asked is at what level of sales EBT of the company will be equal to what? Zero. These are some additional questions, right? As we move further, the pattern should a little bit get complex, no? Right now, if question number 5 is also like question number 1, then like, there's no fun. So something additional has to come with every question, and that is what is happening. Okay, so let's deal with it. Okay, so what is your plan? Variable cost not here. Congratulations. I think first we will present. See, we have to find EPS also. Correct, as you can see in point number 2. Let's do one thing with creator. As I created a blank income statement in the earlier question, same we will do over here also. Okay, that will give us a breakthrough how to proceed further. Yes, let's talk about solution to classwork question 5. And as I said, first we will keep it in the form of what we will first clear our income statement. That will give us a breakthrough, like how we should proceed further. So start from sales, less what? Variable cost. Gives us what? Contribution. I'm writing you can try, no? I'll just writing the blank format. People are like, no, no, we want to try. Okay, try, no problem. You try is more than a happy scenario for me. I think we can quickly calculate interest. 12% of 2125 lakhs. Let's tax at 30%. So we get EAT oblique NPAT. Less preference dividend is still going nil. So we'll have profits available for equity shareholders. Guys, you know now this income statement is filled up, then you can easily calculate most of the things. I'll give you 4-5 minutes to try it out. We have not changed PV ratio to GP ratio, but we are writing day. So make sure you solve the sum. How we can change it? There are two different things, Ray. So make sure what you are doing. So yeah. Ray, you gone mad or what? Tell. You know that sales minus cost of goods sold is GP. You know that sales minus variable cost is contribution. How it would be similar? I just told you that, okay, see, compare how sales minus COGS is GP minus operating expenses is EBIT. So what is the basic idea? Cost of goods sold and operating expenses. Out of that, few are variable costs, few are fixed costs. So we bifurcate that. I never told you that GP ratio is same as variable. I'm still saying, that it is how you understand. Okay, if you make it like sales minus COGS GP, then you take GP ratio as what? GP upon net sales. Here you do sales minus variable cost as contribution. So what is the profit volume ratio? Contribution compared with that of sales. What, Laksha, what is this? Not getting your answer. The online killing facility should be there. Wait, keep quiet. Chalo, people, let me do one thing. Much people have started posting a lot of answers. Let me start solving. Huh? That is a better option, it seems. Okay. Fine, people. So this is the setup. I was actually I had stopped sharing the screen. I thought that let me, by the time you are writing, I will also write. But then what will happen? Directly the ready-made solution will pop up in front of you. It will be like, from where the figures came. So that's why I stopped. Fine. Mohit is, yes, Mohit. Give me 2 minutes. 2 minutes, please. Sorry, I did not give you any expressions. So sorry. I received a complaint that I am not giving any expressions to the answers posted. So sorry, I apologize. Okay, let's calculate, guys. So the first thing asked to us is what? Now pay attention, all of you. Okay, so by like, but now I have got few messages saying, sir, this chapter seems to be much easier than other, and then like suddenly something crop up like shit. There is a complication here also. Life was complicated. We knew it since beginning, right? But we were really thinking that this chapter seems to be a little simple. So, okay, it is few things here and there. Don't worry. So the first thing asked is what? Financial leverage. And I'm confident that everybody has tackled with it. Using the information given in question, correct? How do we get combined leverage? We get it as operating leverage multiplied by financial leverage. So you have just substituted the values, right? Combined leverage is 2.8. Operating leverage is given 1.4 into financial leverage. So I'm pretty sure that you all got financial leverages too. Correct, friends? Alright, 2 minutes, people. 2 minutes. Wait, hold on. Now hold on. Don't force me to stop your chat. I understand that people have calculated the answers and people like, sir, confirm our answers, sir. Wait, man. That's what I'm doing now. I'm also calculating. Okay. Now, see, a few things that we know. Fixed cost excluding interest over here Means operating fixed cost 204. Correct, friends? Right? Okay. Sales is what we already know. How much? 3,000 lakh. Okay. Fine. Interest you could calculate, right? 2.25 lakh into 5% came to 255. Interest. Correct, friends? Right? Okay. What else you could write? Nothing. That's it, sir. Okay. So now how to proceed further? How to proceed further? Sir, we are almost sure that we will use any of these leverages to move further, right, sir? Sir, we know operating leverage, we know everything. So contribution upon EBIT, sir, operating leverage. Contribution not known, EBIT not known. Okay, yes, sir. So, sir, let's go with the financial leverage. Okay, EBIT upon EBIT. Sir, EBIT not known, EBIT not known. How we will solve this? So there are some tricks, guys. There is a simple trick which we should utilize. Okay, wait. See how to proceed further. You just now got financial leverage. What is that? EBIT upon EBIT, right, friends? See, there is a. You remember in the ratio topic. In the ratio topic, I taught you a trick. In balance sheet, sources of funds is equal to application of funds. You remember that? Debt plus equity is equal to fixed, and then we substitute proprietor fund is equal to something, and then suddenly we get everything. Something very similar we have to do over here, friends. No big deal. No big deal. So, financial leverage is EBIT upon EBT. So that too we know, sir. No values are there. Hurry, come on, people, wait. Can I say EBIT upon EBT as EBIT minus interest? What say, guys? Huh? Is it right what I am saying? Yes. Okay, then that gives us a breakthrough. That is what we have done. Okay. Therefore, I know, hello, maths experts. Please don't cancel that EBIT and EBIT in the numerator and denominator. Interest we know now. Maths, cross multiply. EBIT is equal to 2 times EBIT minus 255, guys. Right. So if you solve this, arrange it properly respecting maths. Minus 510, I take this side becomes 510. EBIT this side become, okay, let me write in full 2 EBIT minus EBIT. So therefore 1 EBIT is equal to 510. Right, people? So put EBIT as 510 and a lot of problems will be solved. Correct. Now you can complete the whole of your statement. Right, friends? Okay. How, sir? 204. So contribution minus 204 is EBIT. How do I get the contribution? You tell me. I did a back now. So 510 plus 204. 714. Right, people? Yes. Now you are on track. So you can easily get the variable cost as 2286. Now everybody like that answers are coming out. Good. Okay. So this minus this, EBIT would be same, not 255. Listen to 30%, 76.5. I request you to keep it 76.5, my dear students. One small key to crack it. Correct, Jay. Mohit. Mohit was like, sir, you don't give any expression to my answers. Sorry, buddy. This is 178.5. Now people are rushing to provide the answers. Okay. Hey, Paresh, what did you write? Sonali Jain. 179. Why? Hey, keep it 178.5, eh? Hello? Any other option of getting it is absolutely fine. Absolutely fine if you worked on uh, operating leverage is also no problem. Keep it 178.5 only, guys. Hello, zero point 0.5. Hey, Baba, this data is in crores, Ray. You round off by 0.5 becomes 50 lakh. It's not rupees and paise to be rounded off to the nearest amount. Okay, back to our work. So I think we have got enough data to calculate everything now. What was our first task? To calculate financial leverage. Okay, so that answer is ready. Huh? Then what we are asked, calculate PV ratio. Okay, so let's do that now. Okay, it's a PV ratio. You write profit volume ratio. Okay, friends, PV ratio means what? Profit volume ratio. What we discussed, that is contribution upon sales into 100. Okay, so how much contribution did we get? 714 upon 3000. 23.8%. 23.8%, right, Mohit? Jay, it's like GP ratio, always expressed in what percentage form. So avoid taking 0.238. Okay, like net profit, gross profit, operating profit. We always put them in the form of what percentage, no, guys? So do that, please. Huh? Rishabh, you got your answer. PV ratio, full form you got. Profit volume ratio. Okay. In this same, you're also asked for what? Earning per share, guys. You're also asked for what? Earning per share. Calculate that. Earning per share, now you know now how to do. Profits available for equity shareholders divided by what? Number of equity shares. Okay. Profits available by how much? 178.5. In crores, guys. Remember that. So what are we told about equity share capital? 1700 lakh. We need to be very careful about all this. Okay. 1700 lakhs. So if I want it in crores, then ouch. 1700 lakh. One crore is how much? 100 lakhs now. So divided by 100. So it will become 17 crores. One minute. One minute. 1 minute, guys. 1 minute. So it's in lakhs. Sorry, we written as it is, no? Sorry, sir. This is in lakhs only. This is in lakhs only. Just that number of shares we want, then 1700 lakhs divided by 10. 170 number of shares. 170 lakhs. 170 lakhs. This one, I was in the previous question in crores. This is not in what we have done. This is as usual in lakhs. We've taken it as it is, right? Okay, fine. The shares are 1700 lakh. Equity share capital is 1700 lakh. No? So just what you have to do to get the number of shares divided by, I'll write over here, 1700 lakh divided by 10 rupees. So the number of shares would be 170 lakh. I hope it is. Sorry, carry forward effect. Yeah, it happens. See, when you can use MPS, even in the ratio, it happened. No, we use the MPS of the previous question in the next question. So just as converted in crores. So 1.05 rupees per share. What else is asked? If the company belongs to an industry, guys, this is a typically what? A typically ratio question. Okay. This company belongs to an industry where asset turnover is 1.5. Does it have a high asset turnover or a low asset turnover? For that, you know what we will do? We'll first calculate its total asset turnover ratio. Then we will talk about it. Total asset turnover ratio. Are we having the company's name? Yes. Of RST Limited. What is that? The sales upon total assets. Right, friends? Okay. So how much is the sales? Right? 3,000 lakhs. Okay. No, it's not about being what they'll be happy, it's about being facts, Ronak. Okay. Now, how we will get total assets? Wait. Hold on, people. Hold on. Okay. See, what we know the question. Okay. Total assets is what? See, this discussion is again important. Listen to me. Listen to me. See, ideally, as I have taught you, total assets are going to be what? Fixed assets plus investments plus current assets. Listen to me, guys. Listen to me, guys. But do you see any chance of getting all this information in question number 5? No, no chance. Okay. Now we need to understand. We need to understand that what we are given in the question is we are given about debentures and we are given about equity share capital. So what we can say? We can say that in balance sheet, I can say like this that equity plus debt plus current liabilities is equal to fixed assets plus investments plus current assets. What I know that equity is going to be 1700. Correct. Debt is going to be how much? 2125. Do we know current liabilities? No. Is going to be equal to total assets. Remember, people, when I explained you returns on total assets in the question and ratio, I had written that, see, current liabilities will be negligible over here. Hello, guys. You remember when I explained you returns on total assets, then I told you that it is close to returns on capital employed. You remember that we had a discussion on this. You see, this is how it goes. And then current liabilities would be a comparatively a smaller number. So we can safely say, okay, fine, capital employed will be too close to what? Too close to total assets. You agree with this, guys, and you remember this? Huh? Okay. So what we can say over here, total assets, approximately, add these two, 1700 plus 2.25, 3825. Understood this, people? Huh. So this is 3825. So you divide 3000 by 3825, 0.78 times. What say, guys? Look at the industry standard. Industry standard asset turnover ratio is 1.5 times. Means what? If they use total assets of 100 rupees, they will generate a sales of how much? 150 rupees, 1.5 times. And here the asset turnover ratio is only how much? 0.78. So efficient or inefficient? Efficient or inefficient? Efficient. You mean to say that this business is efficient? You gone mad. Array, people, what are the total assets of this business? We just now calculated, no? See, hello, industry total assets are 3825. If you put industry standard as 1.5, then 3825 into 1.5 comes to this much. They should have sales of how much? 5737.5. So this is once again I'm asking, this is efficient or inefficient? Inefficient. Bad. Understood, friends? Did you understand this? We need to first understand the interpretation that it is 1.5. The general, all others are doing like 1.5, and this is pathetic 0.78 only. Okay, so yeah, let's write about this. So write over here, write a note. Industry standard is 1.5 times. That is generate sales equal to 1.5 times of total assets. But RST Limited has asset turnover of only 0.78 times. That is what? Sales only equal to what? 0.78 times of total assets. So what will you say? Therefore, what? Efficiency or inefficiency? Inefficiency, guys. Therefore, inefficient utilization of total assets. Sir, provision for tax is a part of current liability. Since we have the provision, can we not add? Where you want to add, Anjani? You want to add over here? Do you know other current liabilities? So what? Basically, we don't know current liabilities. Provision for tax might be one of them. Do you know what is current liabilities? No. What for? If you are not yet done with the question. Still one part is left. Are you done writing till here? Then we'll talk about the next question. What is told C? At what level of sales EBT of the company will become equal to 0? That's what they are asking us. Okay. And quickly attend this part. At what level of sales EBT is equal to 0? So I'm writing nil. So let's make a quick income statement. Sales minus variable cost gives us what? Contribution less what? Fixed cost gives us what? EBIT less what? Interest gives us what? EBT. Enough, no? We want to find out that sales where EBT becomes 0. True, friends? Yeah, you can make an additional column in the first statement. Absolutely fine. No worries. So what we want the EBT to be nil. Correct? Okay. Let EBT be nil, but will there be any change in the interest cost, guys? Interest cost will remain same, na? Why? Interest is a fixed financing cost. So it will remain same, 255. Okay. So what minus 255 is nil? Has to be 255 only. Going reverse. Correct. Okay. What about the fixed cost? Fixed cost will also remain same. 204. Okay. So what minus 204 is 255? Add it back further. So 55 plus 204. 459. True, friends. How we will proceed further, but you did not see. Hello, 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 hello. Sales minus variable AIS. I was coming to that point, Bharat, correct. Sales minus variable cost contribution. You know what? This percentage will remain same. Correct, friends? This percentage will remain same, right? So we will find the percentage. What is the variable cost? What we know right now, is contribution. So we'll find contribution to sales. Na? Profit volume ratio will find na? 714 divided by 3000 percentage. It came to 23.8%. Contribution came to how much? 23.8% of sales. Okay, so that's a trick that we are using. We will say contribution to sales ratio. Hey, hello guys, same PV ratio, profit volume ratio. That will be contribution upon sales into 100. Contribution was 714, sales is 3000. So we got the answer 23.8%. Correct, people? We have taken these figures. Now we know that this will not change, no? Even if the sales increases, the percentage will remain same. What does it mean, friends? If this is 100, then this is 23.8. So we can just calculate sales now. Tell me how we will calculate sales. We'll say, sir, 459 is 23.8. 100 is how much? To cross multiply 459 divided by, okay, into 100 divided by 23.8. We got it 1928.57. Right, friends? Okay. And then the difference between the two, 928.57 minus 459. 1469.57. Yeah, you can find in the form of percentage also. No? If this is 23.8, then 100 minus 23.8. 76.2%. Variable cost would be 76.2%. If you want to find out with the percentage part. Absolutely fine. Hello, people. You are understanding what am I talking? Sure, na? Okay. Okay. Fine. How much is this? Clear, na? Good. Okay. So I think we have attended all the questions from this part. Right, people? Okay. If you want, yes, yes. Screenshot mandatory, sir. Now, Someshwar, sir, change the view, sir. Make it 2 page, sir. After doing 2 page also, it is like this. That I can't help now. Twist is on the way now. Twist is almost there, guys. Here itself. Hmm. Done, people? Okay. Now, see, you remember the leverages that we learned today. The leverages that we learned today. Operating leverage is what? Percentage change in EBIT upon percentage change in contribution or sales. Financial leverage we learned as what? Percentage change in EPS upon EBIT. And combined leverage we learned as what? Percentage change in EPS upon percentage change in sales or contribution. See, we have some 15 minutes, right, friends? Okay. Uh, okay. So people are asking. The theory part given in the book is what you have to do on your own, right? The theory questions given at the end. Share market I don't teach, friends. So don't be under a wrong impression. This is a financial management class. Yes, I can show you where to see the relevant ratio because people like you know everything. See, if I know everything, nobody in the world knows everything about share market. Always remember that. So people are like, okay, he will tell us something. This fellow who comes early morning every day and tell us something that from tomorrow onwards I'll start making lakhs of rupees a day. Then I will also not come. No? Okay. So yeah, it is an illusion. So uh, insider information. What now? Losing the track. David. So Warren Buffett is a different case, man. See, there are only one or two Warren Buffett in the world, right? Only one, better to say. So I don't deal with all that. My intention to tell you was that you go to money control and check all the ratios that they calculated over there. Okay, that was my intention. That is the only thing. Second thing, what is more important right now is to teach you this part with the help of the leverage. Okay, because people are like, sir, this topic is very simple, sir. It is not giving us any kind of kick. So the kick will come. The kick will come. Okay, what they have asked you to calculate, they've asked you to calculate the earning level of earning before taxes. Okay, at what level of EBT sales will be equal to what? Sorry, at what level of sales? Sorry, EBT will be equal to 0. That's what is our question. So where this comes into picture, guys? See, give me some time. I will show you. See, when the question was like this, you took it very simple. At what level of sales EBT would be nil, and you just did it like that. Okay. If I twist this question, if I twist this question and I tell you, sorry, you're not allowed to use like this. This belongs to topic of leverages, right? Very important discussion, guys. Listen to it. This belongs to topic of leverage. So you have to use the concept of leverage. So how, sorry, this is democracy, sir. We want to solve like this, we'll solve like this. We want to use leverages, we'll use leverages. Okay, so I'm telling you, this comes in exam. Suppose, okay, the same question is asked to you. Okay, at what level of sales EBT will be nil? Calculate or estimate using the concept of leverages. Okay, and whatever we have done by common sense just now would fetch sympathy, but no marks. If the question is very clear that you do this, you find that level of sales where EBT will become what? EBT will become 0. Hearing me? So what will you do in such case? If I ask you that you have to use concept of leverages only, na guys, then it is going to be a tough task. Okay, so that's where the leverages play a role. Okay. See, what we have to do is we use the concept of leverages in the relevant way. Okay, we'll do one thing. As such, I have to explain you. So listen. You rack your brains on this. As such, I have to explain you the importance of preference dividend. I have to introduce that tomorrow. Okay. So I'll cover up that part. We are left with some 9 minutes, so it will be very difficult for me to club all those things. Think on this. Like I've left something in your mind. Okay. Think on this, how it will work. Fine. And today I'll just quickly show you what I means because hardly 9-10 minutes are left. So this discussion, you have one more lecture after this, right? So this will not be possible at 10 o'clock. I know. Not possible for me to cover in that small span of time. So let's keep it for tomorrow. I was to tell you how to adjust the leverage to arrive at this answer, but looking at the time factor, we are not doing that right now. So I'll quickly do what the other way around. I will just I'm just telling you that you go over here, or if you have an app, doesn't matter. Just any share that you search for and see the ratios that they calculate. That's what I was telling. Okay. Yesterday somehow it was not scrolling. I couldn't get it. Today I hope I managed to get it. Price volume. So for deals, insider transaction, corporate action. Yeah. See, just see. They've classified the ratios, okay, per share ratios. See, once you start working in the real world, okay, the classification becomes as per convenience. Okay, we to remember the thing you have put into P&L, balance sheet, and mixed ratios. Here they have some other ideas. Okay, like see, these are per share ratios, basic EPS, diluted EPS, book value, right? You remember this book value we had learned how to calculate the book value. The book value would be calculated on the basis of what? Equity shareholder fund divided by number of equity shares, right, friends? So if you want to confirm that, say go to balance sheet. Okay. See, add this share capital 4 crore. See how funny things these are, huh? 4 crore share capital. Okay. Add the reserves 12,210. This is your total equity shareholder fund. There are no miscellaneous expenses. Okay. Now this is in crores. I think the face value of their share is 10 rupees. It's not written over here, but it is 10 rupees. So if you divide it by number of shares, no, 4 crore is a share capital. No? Only 4 crore is the equity share capital. 10 rupees each share. So divided by, you will get 0.4. You will get 10 rupees share. So you will get how many shares? You will have 0.4 crore shares. So you divided by 0.4 and you reach 30,000. I don't know whether you are able to see this or not. I got the value as 30,000 something, right? Now, if you see the value calculated by them, yeah, slightly different. Why, sir? Because this is 28,808 and we got 30,000. See, they have written the reason in the bracket, excluding revaluation results, right? So while calculating what they have done, they have not taken revaluation results into consideration. What we did, we added everything, na 4 crore and 12,000 something something. Revaluation reserve, they know better than us, obviously. That then we have to get into the full balance sheet. We don't know that. So we calculated, we got 30,000 something. So this is actually calculated like this. Now, if you take a look into the margin ratios, see in margin ratios, they're actually calculating gross profit margin, operating profit margin, and net profit margin. What you are doing, right? Return ratios, return on net worth. See this, return on equity, return on capital employed, return on assets. Then see leverage ratio, debt equity ratio. I told you now in real world, leverages includes debt equity, interest coverage ratio. So these all the ratios are there. Like what you can do, you can log in over here and compare the performance of the peer companies, like matching companies. They are always there. Okay. If you compare now, see cash flow also you can see. See, same thing guys, whatever you learn, no? Operating activity, investing activity, financing activity. I have doubt there'll be no further details of this. No, see, it's not there. You got it? Means they're not writing like cash received from customers, cash paid to suppliers. All those things they are not writing. It's a abridged value. Okay, fine. Operating this much, investing this much, financing this much. Okay. So whatever you are actually doing, guys, everything is available over here. You can go. I don't market for moneycontrol.com. Okay. I don't market for them. You go any site like yesterday, I think Lakshya has told ticker tip, right? Now Lakshya has told ticker tip. Ticker tip is also in official website. Exact statements are there. Yes, yes. Obviously, they'll be there. Now, they have no choice but to disclose the things. You know that you are studying Companies Act, and then you know, right? Everything would be available. You can compare like that. Like if you want to compare book value of MRF and that of book value of Apollo Tires. So there you will have to investigate how much is their share capital, how much is their reserves and surplus, and then you will have to find their number of equity shares, and then you will realize that they have a huge number of equity shares. Yesterday I had explained to this that it's like India's national income, huge amount of national income, but equally divided by further huge population. So per capita income is very small, right? See, that's why the ratios will play a role. No, talk about the current pandemic situation also. Okay, now the numbers are like quite scary. Okay, but you see India's population, it is double scary. So when we see the ratio, okay, that number of cases, active cases or positive cases per million of population, or number of deaths per million, I'm just trying to tell you the importance of ratios. When you see in general, so you see that India is ranking second in the number of active cases. But when you see the ratio, or when you see the ratio of deaths per million population, we are 122nd country. The issue is what? Our population is huge one, right? 140 crore we have crossed. Okay. So anyways, so people need a screenshot of. What you want to see my portfolio? You really think that I'll keep it over here? Jocks. I'll do one thing. I'll fit it in a page. Yeah. If you are done, you can leave. I'm not continuing. Means I'm not adding anything now. Scroll a little. Okay. Done, people. Ovia, if you could put in the chat box, please. in case you need notes. Okay, so please copy this. Yeah, Array people, we forgot. Ratios at glance, I forgot. Sorry. Oh yeah. OV, yeah. Talk to me. We'll type till the end of the world.
Sir, good morning, sir.
Good morning.
Sir,